Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. In the type of market conditions that we're currently experiencing, with plenty of volatility and no apparent end yet to the downturn, many investors and traders, including myself, for the record, are looking for ways to either hedge the market or earn some income to offset some of the portfolio losses, or even, wait for it, book some profits during the bear market. Now, I personally do a few things in my own portfolio during a bear, including inverse ETFs and some options. Now, back in the day, when I learned to trade, I learned a system that suggested bailing out and going to cash in a bear market. And, it's 2022. That's a little outdated given the tools available to us today. First, that kind of trading can have some pretty significant tax consequences, at least in a non-qualified account. But second, it's just not necessary anymore. So today's guest, CC Lagator, joins the show to discuss option strategies that you can begin using today. And yes, he does operate an options trading platform, but he's very generous in sharing strategies you can use on any platform or brokerage, not just his. In fact, he gives you some specific actions to take in the current market conditions and offers some guidance for developing an option strategy with the greatest probability of success, whether you are trying to hedge or create income. This is another great interview with very detailed action steps, so you'll want to pay close attention and even take some notes. You can implement these suggestions in your account immediately. Give a listen to today's interview with CC Lagator of Options AI. All right, CC, tell us about the origin story of Options AI and what are you trying to do with this company?
Well, so my background is I was an options market maker. So I was on the professional side of the business, essentially making markets for, both institutional and retail order flow. And one of my co-founders, he came from the institutional options brokerage side of the business. And, we've been kicking around this idea for a couple of years about, the retail space and options. And just as like a little bit of a background on how that looks, retail options trading looks very different than institutional options trading. And when you see institutional options order flow, it tends to be multi-leg options. A lot of times it's against, positions that they have at the, hedge fund or institution or mutual fund. And whereas retail options order flow tends to be really speculative, really low probability in a lot of cases, and it's essentially like the term is people, lotto tickets or, YOLO trading of the last year or two. And so, we sat down and we started thinking about, what is the issue? There's a couple of issues in retail options trading. One is just simply, people dive in and the things they understand very quickly are, I think a stock's going to go higher, so I'll buy a call. Or I think a stock's going to go lower and I'll buy a put. And that's, one of the main entrees into for most people experiencing options on the retail level. But, we looked at the products themselves. And that it was actually, nothing, there's been small innovation around the edges in the business in this space. And options are a massive part of retail brokerage. Like it's a lot of people, have experience opening up a brokerage account and then, dabbling in options. And what we were looking at the products themselves and thinking, there's problems in the products themselves that are pushing people into these low probability trades. And, an example would be, here's an expensive stock like a Tesla or Amazon. I'm going to scroll the options chain to see a call that I can afford, right?
I've seen that, yes.
And so then what ends up happening, unfortunately, is that's probably something that has a 10% probability of profit. Whereas, the way an institution would, or an experienced options trader would approach something like that is they'd say, I don't think that Amazon is going to go up 25% in the next month. Why would I ever own a call that's 20% out of the money? And therefore, they would look at it more strategically and say, but Amazon could go up 8% on this earnings report. How do I position myself for that happening? And how do I limit and define my risk in case I'm wrong? And that's sort of the first level of kind of advanced options trading, which is, really trading around a plan with defined risk and not buying the improbable, setting up for the more probable, right?
Well, let me ask you a question on that, CC. So how it sounds like for many retail investors, and that's a great point about people might be looking for something that's affordable without thinking about the other ramifications of the trade. How do you get out of this opinion-based thing of because that sounds pretty risky, right? I think the stock will go up. I think the stock will go down. How do people get around that to do something that does have more probability of succeeding?
Yeah, well, there's a couple of ways, and that's sort of the third level of people's experience into options. Hopefully, if they've made it through that part of the journey, is options also allow you to position against something happening. So for instance, if right now if people are looking around at stocks in the market that they think have been oversold in this sell-off, there's ways to essentially say, I'm going to sell a credit put spread below where the stock is trading. And if this market does not follow through down another 20%, I collect that premium. And you'll hear this term in options trading called income trading. And that means a couple of things, but one of them is an example like that, where you're essentially positioning against something happening. And when you do that, you have a higher than 50% probability of profit on those positions. And then the other way that someone could, sort of use options within a more, buy low, sell high type strategy is when you are long stocks and long a portfolio, you can sell call spreads, for instance, to the upside of where the stock is trading. And a lot of times, a good mentality is basically, I would lighten up on my positions up there anyway, right? So I might sell some of my, stocks or my holdings if the market rallied up until this point. And so you can position and add income potentially to, a long stock or a long stock portfolio by selling calls and selling call spreads. And again, this is, if the stock just goes sideways, I collect that premium from those options.
So do you recommend pairing these options with going long in the stock? I know a lot of options traders do kind of work that way. What is your thought on that?
Well, you see in the market itself, you see everything, right? So you see that speculation, and that's essentially people using options for leverage, right? And so they're essentially saying, I'm a buyer of this stock. How can I position in options so that, I'm only risking X amount of dollars rather than tenfold that amount? And so that's one, particular way to do that. Now, if I would say, options are not for everyone, and, it takes some learning around, how they work. There's a lot more variables in an option than there is on a stock. Essentially, I always tell the, sort of the metaphor is, if you see odds of a horse race before the horse race starts, and, there's an 80-1 shot and a favorite and, all of those things, what the options market is, or derivatives in general, is that it's a live market all the way up until the last second of that race. And those odds are changing the entire way, right? Mm-hmm. And I think that's a good way for people to think of options, is they are diminishing asset that has a time frame, right? Which is very different than just buying a stock. When you buy a stock and it goes down, you can, hopefully, it comes back at some point, you can wait it out. With options, they are, if you have a 2-month expiration, that's your 2 months for something to happen or not happen. And so I think a great, going back to that conversation about potential income and things like that, if you're just sort of an investor and you have no interest in any sort of speculative options trading, there are opportunities there to add income to those portfolios. And it's sort of, if you're comfortable with that and comfortable sort of actively watching those things, because they, you can't just sort of set them and forget them, right? And check back in on your portfolio in 6 months. You kind of have to pay attention to what's going on. If you're comfortable with that, then that's opportunity out there that you wouldn't, have otherwise, like a market that's going sideways or a bear market, there's opportunity within options to sort of trade around your portfolio.
Can you give some examples of that? Because I think that too many long investors maybe either are a little bit intimidated or maybe don't think they have the time to use options in their long portfolios when they have more of a longer term time frame rather than just trading as a swing trader or day trader, for example.
Yeah, so I think there's a couple of examples. So, we're human, right? And we make really bad decisions under stress, right? In our portfolios, we panic, we sell low when we, didn't need to. We get euphoric at highs, like all of those things. And I think options are really good in a couple of different ways. One is the simple, sort of like hedging strategies, right? So this is the type of mentality where, let's say you want to be a buy low, sell high type investor, but it's very difficult, right? And especially under times of stress. There are ways that you can hedge portfolios and hedge, let's say you feel you're a little overweight in one stock, like let's say it's like Tesla and it's keeping you up at night because it's so crazy. You could say, I'm a long-term holder, believer in a Tesla. That's not a recommendation. I'm just saying it's an example of a lot of crazy stock that a lot of people own.
Uh-huh.
Well, you could do options, you could do put spreads and things like that basically allow you to sleep at night and avoid those bad decisions at lows, right? And the same thing on the upside, instead of just having to make a decision to sell a stock because you feel like you're getting a little overweight and maybe that stock's getting extended, you could do those strategies that I was, referring to earlier about like selling calls and selling call spreads against those holdings. And if the stock went up through those levels, then you already were a seller up there, but you don't have to make that decision that day. You're just sort of putting it 10% higher in the stock. And if it happens, it happens. And you would have been thrilled to sell up there anyway. If it doesn't happen, then you've gained that income of essentially selling to something, positioning against something happening.
Do you view a strategy like that as more of a way to add alpha or more of a way to protect your capital, a little bit of both? How should the listeners view that?
I think it's a little of both. And I really go back to the psychology of, I was a professional trader. And one of the greatest skills you can have as a professional trader or an investor is sort of recognizing your own cognitive biases, right? And you're constantly checking yourself. You're saying, you see patterns where there are no patterns. There's, all kinds of mistakes that this brain of ours can make. And these are ways to sort of have a plan. And that income, that's money out there in the options market. The options market is really efficient and a lot of other people are using it incorrectly. And a lot of other people are using it in the opposite way that you might want to. And so if you are long a portfolio of stocks, there's income upside of those stocks available within the options market. And then the same thing with the sort of hedging strategies, I would consider those, how much am I willing to pay to be able to sleep at night and not make bad decisions in volatile markets, right? And so I would look at them both ways. I think the income thing is something everyone should, if they're interested in that sort of thing, they should explore. The hedging is, I think a very good long-term strategy if you are the type of person that can get affected by, for instance, this current market. I mean, if you were long an Amazon and you just watched it go down 25%, but you're like, I never want to sell Amazon in my life, then, the options, you can say, well, I'm willing to give up 3% in Amazon so that I can hold it for the next 25%, right? Or whatever it is. And so I would say both ways. And now, an ideal situation is you're doing both, right? You're selling upside for income, and that's allowing you to pay for protection on the downside.
Yeah, that makes sense.
And an ideal options portfolio, I mean, there are no ideal anything, but what I would say, when people ask me, what should this look like? There's two ways to go wrong in options. One is to have really high probability that essentially that nothing could ever happen. And we call that like picking up pennies off the train track.
Yeah.
Essentially, like if you look at your options portfolio and you're at 95% probability of profit, that's not a good position, because the one thing that goes wrong is you're risking too much to make too little, right? And the flip side of that is obviously, if you look at your options portfolio and you have a 10% probability, that is a YOLO portfolio of options. And it's the way that to die by 1,000 cuts over time.
That makes sense. Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. Well, let's talk about this specific market right now. You know, investors had gotten accustomed to in 2020 and 2021, just so many of these growth stocks just adding and adding and adding to their gains. All of a sudden, the situation changed. I mean, you alluded to a couple of mistakes people could make already, is just selling at lows, or maybe just holding with no idea of protection, no idea of any type of hedging strategy at all. And there's a number of hedging strategies you can use in a portfolio, but specifically to the use of options right now in this market, what do you suggest how people should approach this?
It's interesting what's happened in the last month or so, or 6 weeks, I think we've been selling off, right? Like the overall broader markets. But man, if you were paying closer attention, like going back to the fall when those, sort of pandemic names and all started collapsing, all those Pelotons and Zooms and things like that, there has been some pain out there that wasn't making the front page of the paper yet, right? And, that was really like the sort of initial signs of this sell-off. And then finally the broader market sort of caught up with it. And now we're in a spot, right? And everybody's assuming some sort of recession, everybody, those sorts of things. We know it ends at some point, right? But we have been spoiled. Most of the sell-offs have been very quick, right? Over the last decade, really. They've been real quick and they've recovered, right? And so the buy the dip, mentality. This one feels slightly different. It's longer, it's drawn out, it's almost boring, the sell-off in some ways. The market's going down like 3% or 2% a day. We're not seeing that huge crash that I think we've been accustomed to where you're like, okay, now I can buy.
Like in 2020, where it just was like that.
It was like, yeah, you blinked and it was already recovered, which was, in hindsight, a little crazy. Yeah, so from an options perspective, what happens is, you'll see this on TV and in financial press and things like that. Everybody talks about the VIX. And the VIX, people refer to it as the fear gauge and everything. There's some things that are true about that, but from an options trading perspective, what it essentially means is options are pricing in uncertainty. And right now, the VIX has been consistently 30-ish, for the last few weeks. And what that means is options are expensive. And what that means for investors and traders is, you basically need the market to follow through in one direction if you are buying options, right? This day to day, like Friday was up and Monday was down. If you are long calls and puts, you're really not getting that opportunity for that follow through, for that, call and put to really be effective. So from a investor and trading standpoint, you have to realize how expensive these options are. And, those things I was mentioning earlier about credit spreads and essentially, positioning outside of this range, that's the way I would be looking at this market. I think it's, unless you saw that sort of classic capitulation where the market was down 10%, on the day, and then it snapped back and things like that. I would be trading this fairly conservatively from an options standpoint, and I would be trying to keep those options trades at a probability of profit of slightly above 50%, and that's like, again, are those sorts of, I wouldn't be rushing out to buy puts, I guess is my point.
Okay.
But you could be doing put spreads, and you could be saying, well, what I want to protect against really is another 25% down from here, right? I can survive a 10% more of this sell-off, but 25% is going to put me in a really bad place where I have to make really, difficult decisions. And those are the sorts of things where, if Amazon, for instance, I think it's just above 2,000 right now. And if that was a long-term holding, then it's not that I want to protect if Amazon goes to 2,000, because I think you should be fine with that. It's that I want to protect if Amazon goes to 1,600 or something on a huge, capitulation crash and things like that. And then if you position for that, what it allows you to do is, ideally, you're sitting on a little bit of cash. What it allows you to do is, then if Amazon were to do that, then you could be a buyer of the stock down there, instead of a seller of the stock, because you need that, you're terrified. And so those are the sorts of things where it's sort of like playing for, singles and doubles and all, and not going crazy into this options market right now, because things are already sort of priced that way. They're already assuming lots of, of this sell-off continuing, essentially.
I like that mindset, because I think far too often investors and traders, and with options as well as just going long, people get into this swinging for the fences mindset, don't they?
Yeah. And that's, again, sort of going back to the origin story of options AI is, we didn't feel like that, those kinds of nudges and that ease to do those types of trades, like multi-leg trades. We didn't feel like that was, the products out there were sort of encouraging this. I just want to buy a bunch of these calls because I'm euphoric, or I want to buy a bunch of these puts at the lows because I'm terrified, those sorts of things. And, we took a view of, if you made this visual, the way most equity traders think of markets and think of stock charts, and this stock has sold off a bunch, we've made it highly visual. And so you can see this call spread, or you can see this credit put spread on that stock chart, really understand what your risk reward is, all defined risk. We don't allow on the platform for somebody just to, sell a bunch of puts, right? Because we want that math to be very easy for people to understand, so that they can make these, better decisions, or at least it's in front of them and it's easier to access, so that they can hopefully make better decisions.
Right. And having the information is the first step toward doing that. So along those lines, thank you so much. You've been super generous with these strategies today, by the way. And I think the listeners, they probably should go back and listen to this one at least twice and make some notes to write down what you were saying here, because you gave us some very specific, actionable ideas today for how to handle these accounts. So tell us, CC, how can the listeners learn more about you and what you are doing over there at Options AI?
Yeah, and so you can go to optionsai.com and read about the platform and, see videos and GIFs and all of how it works. And I think most people's reaction when they first see it is like, whoa, that looks really different than my current platform. And then what we also have, there's links there. We have a couple of things. We have free tools that we publish. And, for instance, we do an earnings calendar where it shows how options are pricing the expected moves for all of those earnings as these companies report. So for instance, Home Depot and Lowe's, and I think a bunch of those companies are reporting this week. And it'll show you what the options market is pricing and then what that stock did on its last few earnings. And that's a great gut check for an investor that owns those stocks, or for somebody that's already, trading options, to sort of set their expectations of what the market is pricing. And then on top of that, we have, a blog and content called Learn Options AI that is linked from there, where I write a lot more about, some of these things we spoke about, and, how these strategies, anywhere from a call to an iron condor, works, and trying to translate it into, plain English, essentially.
Right. Because it can be intimidating for newbies, for sure.
Yeah.
So, All right. Hey, CC, thank you so much. Really enjoyed having you on the show today. Appreciate the generosity of the information and hope to have you back some other time.
Yeah, thanks so much for having me.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.